Understanding the yen carry trade, what it is, and how it affects the markets. What is a carry trade? A carry trade is an investment strategy where an investor borrows money in a currency with a low interest rate and invests it in a currency with a higher interest rate. This type of relative value or arbitrage trade can generate profits from the difference in interest rates between the two currencies. However, when markets over-leverage in such trades, it can lead to significant market disruptions when conditions change. The mechanics of a carry trade. To illustrate, imagine you want to invest in a rental property. You borrow dollars at a 7% interest rate, resulting in a $2,000 monthly mortgage payment. You then use those dollars to buy a property and place a tenant, collecting $2,200 in monthly rent. After paying your mortgage, you have a $200 profit. Although this example involves a single currency, it demonstrates the principle of borrowing money at a lower cost and investing it to gain a higher return. In a true carry trade, two currencies are involved. For example, if you borrow Japanese yen at 1% interest and convert it to US dollars to invest in US assets yielding 5%, you pocket the 4% difference. To make this trade profitable, investors often use significant leverage, borrowing large amounts to amplify their returns. The yen carry trade. The yen carry trade has been particularly popular due to Japan's long-standing low interest rates. Here's how it typically works. 1. Borrow yen at a low interest rate. Institutions and investors borrow yen at Japan's low interest rates, often around 1%. 2. Convert yen to dollars. The borrowed yen is then converted into US dollars at the current exchange rate. 3. Invest in US assets. The US dollars are invested in higher-yielding assets like money market funds or US Treasury bonds, which offer returns between 4% and 5%. 4. Pocket the difference. Investors earn the spread between the returns on their US investments and the interest they pay on their yen loans, usually around 4%. This trade is considered nearly risk-free, and its profitability leads investors to leverage heavily, borrowing as much yen as possible to maximize returns. The impact of currency movements. The yen carry trade is highly dependent on the relative strength of the yen and the US dollar. Historically, the yen has weakened against the dollar, benefiting investors who can repay their yen loans with fewer dollars. However, recent shifts have reversed this trend. Federal Reserve rate cuts. The market anticipates U.S. interest rate cuts, which can weaken the dollar. Bank of Japan rate hikes. Conversely, Japan has raised interest rates, strengthening the yen. These changes increase the cost of repaying yen loans with U.S. dollars, especially for highly leveraged positions. If the currencies move unfavorably, investors may find their dollar investments insufficient to cover their yen liabilities, triggering margin calls and forced asset sales. The unwinding of the yen carry trade. When investors start unwinding their yen carry trades, they need to buy yen and sell dollars, further strengthening the yen and weakening the dollar. This process can cause significant market volatility and lead to large-scale liquidations, affecting not just currency markets but also bond and stock markets. The domino effect on global markets. The unwinding of the yen carry trade can have widespread repercussions. Stock market impact. Investors may sell U.S. stocks to cover their yen loans, driving down stock prices. Volatility spike. The VIX, a measure of market volatility, can spike due to increased market uncertainty and the forced liquidation of positions. Conclusion: not a black swan, but a gray rhino. The current situation is not a black swan event, an unpredictable and unprecedented market shock, but rather a gray rhino, a highly probable but neglected threat. Overleveraged trades like the yen carry trade have historically led to significant market disruptions when conditions change. As markets adjust, expect some funds to face severe losses and the ripple effects to impact various asset classes. We hope we provided you with a comprehensive yet straightforward explanation of the yen carry trade and its market implications. By understanding these mechanics, investors can better navigate the complexities of global financial markets.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.